Jumpstart is a signature professional development project of the Rotaract Club of Achievers Lanka Business School, which is conducted for the fourth consecutive year. Jumpstart is a platform for budding entrepreneurs to pitch their creative business ideas to a panel of judges in order to win prizes worth 100,000, along with knowledge and mentorship from the best in the industry. Also, we connect growth stage startups with investors and give them an opportunity to receive investments for their businesses. Today's workshop will give you an understanding on the fundraising journey of startups, how to build a good investment deck, and so much more. Before moving on to the workshop, I would like to thank our sponsors. Our sponsors for Jumpstart 2020 are SEMA Sri Lanka, Bronze Partner, Venture Frontier, Knowledge Partner, Shirtworks, Gift Partner, PwC, Advisory Partner, ELO Chambers, Legal Consultation Partner, Hub9 Co-working Space Partner, Startup X Foundry, Mentoring Partner, My Shopbox, IT Solutions Partner, Chocolate, Media Partner, and Turu, Reforestation Partner. Here's a small shout out to our bronze partner SEMA Sri Lanka, gift partner Shirtworks, and co-working space partner Hub9.
Our story is one of reimagining. Reimagining who you can be, what you can achieve, and how SEMA can support you. By reimagining and delivering the skills that create value for businesses, we are building an ecosystem of progress and placing you right at its center. Reimagine your career. Contact SEMA Sri Lanka.
Hi guys, my name is Pula. I'm an entrepreneur. I work as a student coach and my business is based around YouTube. Hub9 has played a major role in my work life. Since Hub9 offers 24/7 access, it has been very convenient for me. Between shooting, editing my videos and doing coaching sessions, I work on a very flexible schedule. There's air conditioning, you can just come in and plug your laptop and start work. There's no hassle at all. The staff and the people you find here are really friendly. You get tea as well, so overall you can just focus on your work and get a lot of it done within a day. The internet speed here is super fast and that has helped me a lot with my upload. There's a chill out area downstairs. I go there when I need to take a break or just a change in my environment. It helps to keep my balance while I'm working here. This meeting room is really nice. I have used it for some of my interviews and I also use it for my coaching sessions and meetings with clients. If you are working here, you can easily book it for your meetings as well. During the pandemic, Hub9 has taken all the necessary precautions to keep all of us safe, so that's all good. The value I get for the 15,000 rupees I invest at Hub9 is just amazing. If you're just starting off your business, this is a good place to start.
Conducted by Mr. Kishan Nadarajah, Principal at BOV Capital. Prior to BOV Capital, Mr. Kishan has worked at Dunamit's Capital investing in seed stage startups and PricewaterhouseCoopers in their M&A division, working on technology companies among other key industries. Mr. Kishan graduated from Texas Christian University with a degree in economics and finance. Mr. Kishan, over to you.
Oh, sorry. Great. Thanks, Aditi. Hey guys. Super excited to be here on a Friday. Very glad that you guys have taken the time out on a Friday evening to join Jumpstart and go through this workshop. So yeah, I mean, so what I want to do is I don't want to take too much time because we're at 7:12. So what I'm going to do is I'm going to do a quick presentation. I'm going to go through some slides, sort of take you all through how startups work, how venture funding is done, and what are the other kinds of funding that's available to startups. We'll take a short 5-minute break, I think, at 7:30 for some ads, I suppose. And then we'll continue. I'll try and stop by 7:40, and then maybe by we'd have about 20 minutes for Q&A. If you guys have any questions. So let me quickly get started. I'm going to share my screen now, so I'll put my presentation up. If you guys can wait till the end of the presentation to ask me questions, that'd be really good so that we can quickly go through the presentation. So basically, my presentation is, Startups 101, right? How to raise venture funding. Essentially, the workshop is also to explain and, sort of give you all some understanding on how venture capital is done and how startups raise venture funding. So what are we going to really discuss today? I've got a whole bunch of things. I'll try to go through most of them quickly. Basically, I want to talk about why startups are important to the economy. How do startups evolve? I want to just touch on a few tech trends. Then, I want to really talk about how do investors look at a startup? Essentially, what's the problem you're solving? What's the solution? Solution is usually the kind of product that you're building. Then, the kind of team that you want to put together. How do you figure out a team? How do you track your startup? And then how do you do financial projections and valuations, and then funding, right? I mean, essentially, how do you actually go raise money for your startup? And then the last thing is, how do you really exit, right? I mean, at the end of the day, you're going to spend 4, 5, 7 years, starting this company and then building. At some point, you obviously want to exit and then retire, and then, I don't know, maybe find a beach somewhere and, relax while your friends who join the corporate world are going to be working for another 30 years, right? So let's go into defining, right? Okay, I mean, a lot of people have this question, right? I mean, should I really, build a company, or should I, get into a corporate job and then continue climbing the ladder? If someone had asked me this question like 10 years ago, 20 years ago, I would have said, what, join a corporate, right? I mean, it's more safe. And you would have stability, and you would learn a lot of stuff that's probably useful. But today, you know what? I mean, if someone asked me what you should do, I would say, just go and build your own company, right? Because it's not difficult to learn how to build a company. Number two, it's not really difficult to raise money. Once you can figure out these two, it's relatively easier for you to build a startup and then, work on your startup for 5 years, I don't know, maybe 4, 5, 7 years, and then you'd probably get an exit. And then, like I said, you could retire significantly sooner than any of your buddies who are actually joining the corporate life. But that being said, I'm not going to say that corporate life is bad. I mean, definitely majority of you would actually join the corporate life. Because startup is tough, right? I mean, it's really hard. It's not easy, right? I mean, even though I make it sound like it's easy, but many startups fail, right? That is the reality. Not every startup is going to solve the problem well. Not every startup is going to generate revenue, and not, some of the startups are not even going to raise money, right? I mean, some of the startups who also raise money will not be able to raise new money, right? New capital. So building a startup is tough. It's not easy, but if you take the chance and if you hit the right opportunity, I think you can build a lot of wealth, right? Okay, quickly touch on a few tech trends, right? Obviously you guys, you guys are probably well aware of all these tech trends that are really out there today. It's quite prevalently known, right? A lot of people are getting thrown all of these, acronyms like AI and big data and cloud computing and all of that stuff. But this is what actually is driving the technology world today, right? Data, we are generating a ton of data right now. Your phone, your laptop, the IoT devices, there's a lot of stuff, your smart cars, all of that stuff is actually generating a lot of data, right? Enterprises, they generate a lot of data, right? So all that data today can be used in a meaningful way to actually, to go and find meaningful insights about your business, right? Today, companies that actually use data do well because they obviously understand where they have to really allocate their resources, right? 10, 15, 20 years ago, we didn't have that kind of data. So we couldn't really, we couldn't dive into the data to learn about our customers or about our businesses, right? But today that's changed. Democratization of tech, right? If you really look at it, all the companies today are actually converting themselves into a tech business, right? The top largest companies today in the world are all tech companies, right? Google, Microsoft, Facebook, Amazon, Apple, all of them are tech-backed. So if you really want to build a company that's long-term, that's going to become large in the next 20 years, 25 years, it would have to be driven by tech, right? So tech is going to play a big role. AI, obviously you guys must have heard about this, artificial intelligence. A lot of decision making, a lot of things are being driven by artificial intelligence, right? Obviously, most of you all use, or probably all of you all use YouTube, right? YouTube's recommendation is driven by AI, right? It figures out what you like, and then it just keeps feeding you with more and more video, and it just hooks you onto it, right? So sometimes you don't even realize that you're just on YouTube for like hours. It's all driven by AI, right? So AI is going to play a big role. Today, yeah, you may think it may not be really important, but then, when you really take things like healthcare, education, AI can play a massive role in changing the way we, operate in these industries. Cloud computing, obviously, cloud computing has made, the democratization of tech. It has brought down the cost of tech, right? Today, if you're an enterprise, you can actually use a lot of the services for very low cost, right? You don't have to really, spend on a lot of big software. 10 years ago, obviously, if you wanted Microsoft, you had to go buy the Microsoft CD. Now that would cost about, 10, 15,000, 20,000 rupees, right? Today, you can just, use their SaaS service where you can just pay on a monthly fee and you can just use it. It's about 800, 900 bucks a month. Many people can afford it, right? And it's all on cloud. You don't have to really use a CD or anything, right? So majority of the enterprise-based business are going to become cloud, right? So a lot of services are going to be delivered out of cloud. So cloud computing becomes an important, technology trend. Blockchain, obviously, you guys have heard of blockchain, right? Blockchain is going to change the way banking is done. Blockchain is going to change the way you trace any product, right? So retail to agriculture to a lot of things. Blockchain is going to change. Then the last one is like IoT, right? Internet of Things. IoT is another. It's device based. It's sensors that captures a lot of data. Whether it's a smart home or whether it's a smart office or whether it's a smart car or whatever that's smart. You make it smart, or a smart city, it's going to capture a lot of data from different data points, and it's going to allow you to make better decisions, right? So a lot of companies and a lot of devices are going to be smart. So that is those are some of the tech trends. I don't want to spend a lot of time today. It's not about talking tech trends, it's about venture. So let's quickly move through. So why are startups important? Obviously you guys probably already know this, because it drives the economy. SMEs are the largest part of the economy and the economic growth. It creates new jobs. Startups create more jobs than large enterprises. And then also startups also create a lot of new innovation, right? I mean, if you really think about it, all these tech companies that have come out in the last 10 years, like Google to Facebook to, some of the biggest tech companies that you guys know of, Instagram and all of them, like TikTok and all of them, Alibaba. So a lot of these startups they started as tech companies, right? So they created a lot of innovation. They make lives easier, right? So startups are the ones that will actually sit down and think through these innovations, and the ones that are successful are the ones that are going to create real breakthrough innovation, right? So startups are definitely an important element of an economy, right? So obviously, Sri Lanka is also really now putting a lot of emphasis on startups, including tech startups, right? Because you can actually export tech products to the region and to the world, and generate a lot of foreign income to the country. Stages of business life cycle. Probably most of you guys know what this is. Businesses actually go through multiple stages. You start a company, that's where you start right here, and then the company will find some growth. It won't be making any profit at the early stage, so it'll be loss making. Then once you find your product market fit, you will have customers paying for your product. Once you start generating revenue, and you figure out how do you make money, that's your business model, the company starts growing, right? And a lot of these early stage tech companies that find product market fit will grow very rapidly, and that's when they start raising the big money that you always hear on news, right? Like the companies that are raising like $500 million, $1 billion, at like 50 billion valuation, right? Ungodly price. And then that's where a lot of the venture investing comes. So the venture investing happens in this area where the growth stages. Venture also happens in the launch area, but it's mostly like seed funds. A lot of the large venture capitals operate in these two areas, right? Launch and growth. Then you have the maturity of the companies. Usually if it takes about 10-15 years to build a company, then it roughly takes about 10 years. It just takes the same amount of time before it actually starts to fizzle out, right? So companies go through this life cycle, right? I mean, it matures, then it declines, and then it's gone, right? I mean, new technology comes in, new startup comes in and replaces the technology. Companies like Google, they continue to survive because they continue to keep innovating, right? They go buy new technology, right? Because they're rich companies, right? Like Apple, Microsoft, they can afford to go buy some of the new technology that's being built, and they can add that to their product portfolio. So companies do that, but you need a lot of money, and you can't do that at an early stage of your tech. So a lot of M&As happen like somewhere around here, like in this stage. That's when companies start looking for new products, because usually a lot of the startups start with one product and they try to build that one product. Then eventually they'll start adding a lot of other products, right? So if you really look at Google, right, they started with search, then they added YouTube, then they added Google Maps, then they added Gmail. They brought in a lot of products, right? They brought Android. If you really think about it, and if you really go down and study these stuff, most of these were not built inside Google, right? They were all bought from other startups that were building these. So if you're lucky, yes, you can also get bought out by some of these large companies that have a lot of money. If you're building something that's interesting to them. I'll quickly. So since this is a funding workshop, I'm going to talk about funding real quick. I mean, I've briefly touched, right? So what kind of funding that's available for startups? So usually at early stage, a lot of startups, are self-funded, right? The founders usually put money. They get money from, their friends, their family. They get, very early stage. You don't need a lot of capital if you're building a tech venture. If you're building a traditional business, definitely. If you're going to run a, real estate, development company, then obviously you need a lot of money. That would be a different way of funding. You can't fund that through venture, but venture capitalists usually don't fund traditional businesses. They fund companies that can scale fast. So you start with self-funding, and then you go to angel investors if that's available. And then once you start really tracking and once you find your product market fit, that's when you really start getting the venture capital, right? Once venture investing comes in, you should be able to rapidly grow, right? Because the venture investors, capitalists, they can write you large checks like $500,000, $1 million, $2 million checks, right? So that is where you would actually really grow, right? Once you figure out that you're solving a real problem. So we have at the very early, you have self-funded startups. Then you move into venture capital. Then once you start growing, you will go into like private equity, and there will be like private equity would be the last part. And then if you want to raise more money, then you also can reach out to you can list your company in the stock exchange and raise money on an IPO, right? You can IPO your company and then raise money through the public markets. So is venture funding appropriate? Yes and no. Sometimes many people think venture capital will really help your business grow fast, and not necessarily. So the most important source of funding will come from your customers, right? If you can build a great product, and if you can spend zero money to market your product, and if people are willing to pay for that product, that is like the easiest money that you can get. So venture capital, comes with, it comes with cost, right? I mean, it has a cost. It comes with terms, right? So you have to give board seats, you have to give piece of your company, you have to give equity, and then you have to, be accelerating growth fast, right? So it all depends, where you are in your life cycle of company building, whether venture is important or not. Bank funding, usually it's very hard to get bank funding for early stage companies because bank funding, they ask for collateral, right? I mean, unless you want to put down your house or your property, it's hard to get bank funding for early stage ventures. What do VCs look for? I'll cover that. And then follow-on funding is basically after you raise your first round, you will burn through that depending on where you are. If you're still building your product, then before you can actually break even and make money, someone will have to fund you, right? So you will go through multiple rounds of funding. You'd hear people talk about seed funding, pre-series A, there'll be series A, then series B, series C, it goes on, right? Like Uber, I think raised like series E and F or whatever, right? Before they went IPO. So there's multiple stages of funding, at different valuations. There's something called the up round and the down round. When you raise funding, you obviously, value your company, and then you raise funding, based on the valuation. So when you do an up round, that means you're raising money at a higher valuation from your previous round. When you do a down round, that means you're raising funding at a lower valuation, right? So up round is good because you dilute less. Down rounds are usually not good because you dilute more, right? So those are some of the terms that you guys should know. Venture funding life cycle. So I just talked about this. You have your angel investments, then you have your seed capital, then venture capital, and then you go into the public market, right? This is when really venture capital comes in this space, right? Where the risk is relatively high, but it still keeps coming down because you have found product market fit. At the very early stage, the risk is high, right? Basically, investors in this area, they usually look for a great team. Can this team solve the problem? Is this team operating in a large market? That's what investors in this very early stage look for. Hey, it's 7:30. You want me to stop?
Mr. Kishan, you can go on. We will let you know when we want you to post.
Okay.
Yeah, thank you.
All right. Okay, so how do VCs? You go pitch to a VC, right? How do investors evaluate your business, right? I mean, what is their side of thinking, right? So basically, I'll give you some pointers, right? So basically, I mean, you have to figure out what are you trying to solve, right? I mean, you're going to solve a problem. I mean, if you're not solving a problem, then you're not going to raise any money because you're not going to build anything. You're not going to build a company. You're not going to generate revenue. So the most important, okay, before that, before you even go to an investor, right, you're going to build an investment deck, right? The investment deck will have like 7 or 8 slides, right, built using PowerPoint. That's the document that you will give the investor to give an initial understanding of what you're trying to do to the investor, right? So if the investor is captivated and if he's really impressed that you're trying to solve something that's important or that's in a large market that nobody else is solving, then obviously you're going to get a call and you'll obviously get a chance to go pitch to the investor, right? So when you pitch, obviously that's when they're going to evaluate the team, right? They're going to understand, is this founder capable of building a large company, right? Does the founder, he or she, have the resilience? Can they do the hard work? Can they work those hours that's required? Can they go through the ups and downs of building a startup? So that's when they actually try to figure out, if this is this a company that's going to be defining and it's going to be, one of their, I mean, should they invest in this company, right? That is the question they ask themselves. So essentially, what do they look, right? First, they look to see what is the problem that you're solving. If you really talk to VCs, right? I mean, they talk to a lot of companies, right? They talk to a lot of startups on a daily basis. Everybody's trying to solve a different problem, and most of the people are also solving the same problem, right? If you really look at education, I mean, everybody wants to go do something on a digital education platform, right? People want to build a platform, put content, and then they want to make money out of that, right? It's the investors get to see a lot of these companies that are trying to do it in different ways, right? I mean, they are in a best position to probably tell you whether this company that you're trying to build will work or not work, right? So they will first figure out, okay, what's the problem that you're trying to solve, right? Is this problem a serious problem? I mean, if there is no solution, or if that solution is not that great, and if you think you can solve that problem better, then obviously, you have answered that question, right? So you have to define the problem well. So first, it's understanding, what is the problem that you're solving, right? The problem you're solving ultimately should generate revenue, right? You should be able to sell the product, because to solve the problem, you need a solution. Usually the solution is a product, right? I mean, when you build a product, that product needs to be sold, right? So you got to figure out, okay, I have this problem. Who is my customer base? Who are the people that are facing this problem, right? What is my market? How big is this market, right? Is this a prevalent problem for a large group of people, or is it a problem for a very small group of people? Obviously, you want to go after the large group of people, right? I mean, Sri Lanka has 24 million population, right? So if you figure out a problem that is there for all the 24 million people, and if there is no solution today, and if you can solve that, you're going to build a large company, right? If you're going to go after a market that's like, let's say 100,000, very niche, right? You're not going to raise any money. Yes, you can build a company. I'm not saying you can't, but it's going to be a small company. It's going to be a lifestyle business. You're going to make revenue that will be good enough for you, but you're not going to build like a large company. I mean, obviously, if you look at companies that started in the last 25 years, like for example, Dialog, right? Dialog started as a small company, telco. Today, it's one of the largest companies, right? It has about 14, 15 million users. Obviously, when they started, they saw the problem where mobile and telephone technology is going to be significantly changed with all the technology that's coming in, right? So they went after a large market because everybody is going to own a phone at some point in their life, right? So they figured, cost of a device is going to keep coming down because hardware is not expensive. Once you figure it out, you can just keep making, a ton of hardware. You can go to China, make the hardware, and bring it and start selling, right? So cost of hardware went down. Cost of data and voice also started going down because more and more users started getting into the network, right? So obviously they were able to build a large company because they went after a very large market, right? So it's very important that you first figure out what's the problem that you're solving, and then number two, how big is that market? How big is that problem for the market, right? If it's a large market, then I think you should attack that. Then once you figure out your problem, you need a solution, right? So I'm going to take this example of Airbnb, right? So your product, obviously, when you start building your product, it's not going to really look cool, right? I mean, you don't want to wait till the product looks perfect, because then you're never going to get off the you're not going to get off the stage, right? You need to launch your product. You need to get your MVP. So if you really look at how Airbnb started, right? I mean, on my left, right here is how they started, right? They just simply went to San Francisco. They found out people who had spare beds, spare mattresses, spare rooms, and they said, hey, you know what? We have this platform. Why don't you just go and advertise on that? If people come to San Francisco and if they can't find a hotel room, they can always, they'll come to our platform and they'll be able to find a place to stay, right? So it initially was called Air, Bed, and Breakfast, right? And then this is where they are on the right side, where the product became much better. They started with just booking rooms. I think now they have experiences. They have all kinds of stuff built into Airbnb, right? So if you really look at how Airbnb built the product, right? I mean, it's a multi-sided platform, right? I mean, when Airbnb, Uber built this in 2008, nobody knew what multi-sided platforms were, right? Platform businesses were very, very new. That's where you build a technology and then the buyers and sellers come and interact, right? So that's what they did. They essentially put up a website and they said you can come and list your property. We'll find you the users and you all can transact. We'll take a commission out of it, right? Simple business model. And they succeeded, right? I mean, it just recently went public. So build a product, right? Once you figure out what your problem is, and when you know how you're going to solve it, you'll need your product, right? So you build your product. So don't wait till you have the perfect product. You need to actually build an MVP, right? A minimum viable product that actually at least answers. It allows you and it helps you first figure out how the customers are using your product, right? So if you try to wait till you build a full product, you may be building things that are not really needed, right? If you really see some of these apps that have too many features, it's useless and it's a waste of time, right? Most of the time, we don't even use all of those features, right? We only use a few features, right? So you have to figure out, by putting out an MVP, right? You can actually understand what your customers want and how do they use your product. It's important that you go get customer feedback, right? So every product iteration, you need to get customer feedback, because that is the only way you can learn whether your product is working or not. If you're building a product that nobody's using or most of the features are not being used, then you're actually wasting time and money actually building all of that, right? So build an MVP, put it out in the market, figure out what the customers want, keep iterating, and then continue building a product till it gets to a scalable product, right? There's another concept that we really look at where you get to product market fit. Product market fit is where your product finds a market where the customers are willing to pay for your product, right? So, for example, if Google Maps were taken out from your phone tomorrow, will that be a problem for you, right? I mean, today I think it'll be a problem for most people because we don't even know where we are going, right? We just use Google Maps and we just put the end destination and it just shows us where we need to go. That's it, right? I mean, today we rely on Google Maps massively. So if Google were to pull out that product, they will lose a lot of users, right? So they found product market fit, right? I mean, they found product market fit where they're able to keep that customer keep coming into the product over and over again, right? That's product market fit. Then you can monetize the product, right? When you find product market fit, that's when you can really monetize and scale quickly, right? The other element that usually investors look is the team, right? I mean, this is like the most important thing a lot of early stage venture capitalists look for. Team, obviously is the single most defining factor for any startup success at early stage, right? Because without a good team, it's of no use having a lot of money and all of that stuff. So it's important that you put together a good team. So usually the team is, there's a CEO. Early stage, the founders are the ones who do most of the work. There's a CEO usually who is the one who actually goes and does all the selling and talks to the VCs, etc. Right, raises money and all of that stuff. Then you have the CTO who actually builds the product, right? He or she is the one who actually builds the product that's solving the problem. So that comes under engineering, and then you have your sales. You usually, the CEO is the one who actually does all the sales at the beginning. If it's actually a consumer business, then you need someone who understands consumer marketing, right? If you're doing B2B sales, then you need to have, you need to know how to do B2B sales, right? Like pre-sales and you do your POCs and then you do your sales closures, etc. Right? So usually, it's very important that you have someone who can sell and someone who can build, right? Those two are very important. If you can't do those two at a very early stage, it's going to be very difficult for you to scale the business, right? And you should be able to, if you're the founder, you should be able to hire. Focusing on recruiting the right team is like paramount. It's super important. You have to spend a lot of time trying to figure out who's the right team. Because if you hire the wrong people, right, two things happen, right? One is they don't get along with the culture and then they screw up the culture. And number two, it's costly, right? I mean, then, keeping them and, you're paying them and they're not adding value. Then you have to get rid of them and then you have to keep, recruiting a new person. You've lost time. So it's very important that you spend enough time and that you recruit the right people at very early stage, because finding the right team can add a lot of value to your financial, because a lot of the people who can come and add a lot of value, it's all about how you sell your vision, right? I mean, as a founder, you should be able to tell a story, right? I mean, you got to be able to attract people with the story that you're selling, and that you're solving a big problem. You're going to make the world a better place. People get attracted to that, right? And they want to come and work for those kind of companies because they know they're doing something important. So you have to be recruiting a top-notch team, right? So that's important. We've already,
Kishan.
yeah.
Mr. Kishan, can I put in a word? I'm really sorry for the interruption.
Okay, go ahead.
This event wouldn't have been possible without our sponsors, and our bronze sponsor for Jumpstart 2020 is SEMA Sri Lanka. Mr. Keith from SEMA Sri Lanka is here to speak a few words. Mr. Keith, over to you. Spotlight anchor under.
Hi, everybody. Hi, Kishan. I'm really sorry to interrupt your session. It's going to be a very quick commercial break for everybody.
No, it's okay. Go ahead. Yeah, that's fine.
Let me share the screen. Just to... Okay, I hope everybody can see the screen. Can the audience actually give a yes in the chat box if you can see the screen, so I can start?
Yes, we can see the screen, Mr. Keith.
Okay, thank you. So today, I think the whole session the students are also doing today is about reimagine. Basically, now not only they are talking about their usual education aspects. Now they have gone and started talking about something like startups, and so today actually my topic will be reimagine as well, and as an organization SEMA, how we have done it throughout these years. So let me start off with one of the biggest issues we as an organization faced this year. This is COVID-19 and education. I'm pretty sure the majority of the participants who are joining today can relate to this. The way we learn, the way we teach has changed. I say it changed forever afterwards, like after this pandemic. So the way we take exams, the way we go for lectures, the way we study, the way we network, it has changed drastically. Not just in a country, not just in an area, not just for a university, it is been changed throughout the globe. So not just the education, it has also changed what the market is looking for in employees. So it's one of the biggest challenge for the education system to cater for the 2021 labor force with the skills which is needed post-pandemic. Today, one of the things I want to talk about is what SEMA is and how we have basically tackled this issue and how you can be benefited out of this. Talking about SEMA, or we call it Chartered Institute of Management Accountants, it is part of a bigger organization which is called the Association of International Certified Professional Accountants. The AICPA is spread across 179 countries with over 650,000 members across the world. And there are around 173 firms and employers who are employing SEMA members right as we speak. And of course, there are 33 offices around the globe. And Sri Lanka, I'm happy to say that it is the second biggest market after UK. We have an office here which caters around 4,000 members and around 10,000 students in Sri Lanka. These are a few organizations we work with. So I'm pretty sure all of you, who is going ahead with the startup would have some at a point followed a company like this about their success story. So these companies, what you see in the screen are our global corporate partners. We have around 2,000 of them. And if you can see the top 5 companies there today, like Amazon, Apple, Microsoft, Coca-Cola, Google, these companies are our corporate partners. So I'm very proud and happy to mention this fact to you all today. So what do we do with these corporate partners is basically we get their help in making the syllabus. What we teach the students, we get the corporate partners help to form the syllabus. So we have around 2,000 plus corporate partners, organizations which is supporting SEMA. And with over 5,500 finance professionals giving us their feedback around 150 countries, we have managed to make a syllabus formula which will cater the workforce in 2025. If you can see, definitely SEMA is talking about technical skills, business skills. And here I would like to stress that it also speak about leadership skills and people skills. Not only that, with the current market need, we also have integrated digital skills. We are talking about all these skills with the integration of ethics, integrity, and professionalism throughout the qualification. So, as I mentioned, we asked the corporate partners what skills our future SEMA graduates should have. And this is what the Forbes magazine say about the top 10 skills for the future. If you can see the screen, majority of it is covered through the SEMA qualification directly. And rest diversity and cultural intelligence, creativity, emotional intelligence, we are covering these aspects through CPDs, or we call it continuous professional development. CPDs are what you get to do once you qualified with SEMA and when you are a member. So once you are part of SEMA, you will not stop learning after you finish the subjects which is there in the syllabus. You will keep on learning and you will keep on updating. This is a special feature I would like to highlight in the organization. These are few aspects like the management accountants bring into the job market these days. It's a good time actually like me to do the presentation, especially after Mr. Kishan talked about hiring talent. So management accountants, they are the business leaders. They are innovation advisors. They are data-backed decision makers. Also, they are forecasters. So management accountant or SEMA caters all these aspects in a business. SEMA has been always a trendsetter. In 2015, we went fully digital. We went fully computer-based. So by that time, before that, all the exams were written by hand. And by 2015, it completely changed and gone to a computer-based exam system. 2019, we included digital skills to a finance and business qualification. And in 2020, when pandemic hit, in May, early as May, we went fully remote on our exams. Now a student can do their exams from their home. The future is going to be the same. As we speak, we have innovated and ready to launch a new platform, which you will get to know by 2021 January. Talking about SEMA, this is the core, this is the qualification syllabus structure. So there are 4 levels in total. And within these 4 levels, I would like to highlight, you will not only learn about finance aspect, you will also learn about enterprise and performance of a business. So it's a well-rounded business qualification, business and finance qualification a person could have when going forward. So why SEMA? These are the few emerging roles which is there right at the market now. There, my dear friends and my dear students. So these are few job roles you can see in the market today: data scientist, scenario planner, RPA manager, social behavioral scientist, data architect, finance value architect. So the job roles as we speak changes now. And SEMA is a qualification which caters the changing demography in the job market. If you can see now, the trend for jobs has been like, drastically changing. There are, jobs involved in data visualization, and they need the digital new tech acumen and storytelling as well when you're going for a job. So these are few skills we are interested in teaching the students these days. Just to highlight, like 65% of the children who are entering primary schools today will ultimately end up working in a new job type that don't yet exist. It also includes us. In another few years' time, we will get a chance to work in something which we never have heard of or even dreamt of doing. For example, take Uber, Pick Me. The traditional truck driver had to learn a new skill, had to change the way they do their job to get more hires. Even the traditional restaurants now, they had to change their way of selling their foods. Most of the restaurants now, they don't even see the customer. They just see the order. By 2030, 375 million people may need to switch occupations and learn new skills. With the current trend, I believe you all will agree with this statement. Again, as I mentioned, the 2 examples, Uber and Pick Me, is a good scenario for this. This is something which I am very proud to mention. I talked about the global organizations which we work with. These are the top 20 employees in Sri Lanka. Employees in top 20 employees in the sense it means these are the companies who hire SEMA graduates the most. On top, you can see MS Holdings and Central Bank, DFCC, John Kills, Haley's, Ernst & Young, WNS Global Services, KPMG, NDB, Dialog. If you see the variation of the companies, it's not just going to be finance. You have telecom, you have manufacturing, you even have a government organization now hiring SEMA graduates. This is what we offer. So we would like to extend the invitation for you all to join with SEMA in your future studies. And this is some statement I want to mention and leave with you in a special session like this. In the new world, it is not the big fish which eats the small fish. It's the fast fish which eats the slower fish. My dear friends, I believe it's the right time to think different. You are already thinking different by coming into a session which talks about startups, and take another step forward and think a bit different about your education pathway as well. I would like to invite you all to join SEMA and like to thank the organizers for giving me this time to do the presentation. Kishan, over to you. You may take over the presentation and go forward.
Oh,
Thank
thanks.
you.
Thanks.
Thank you, Mr. Keith.
Thank you.
Over to you, Mr. Kishan.
Okay, thanks. Okay, so we spoke about how do you pitch to investors. You define a problem, then you figure out the solution. How are you going to solve it, and the solution being what's the product you're building. Then we spoke about building a team, which is an important element of what venture capitalists usually look for. Then let's look at a few other things that usually VCs look for, right? Obviously when you start building a company, I mean, you have to start preparing financial statements, right? That is the only way your investors know whether the money that they're giving is being spent in the right places. Are you actually spending the money on building a company, or are you actually building to party, right? So you have to give them regular updates on where the money is being spent, and also how you're generating revenue, if you are generating revenue. If you're a pre-revenue company, then you have to understand and inform your investors on a monthly basis where their money is being used, whether in product development, or you spending money on salaries, or you spending money on sales and marketing. And then you obviously have things like you need a space like rent and then utilities, etc. Right? So I don't want to touch too much on financial projections. I think you should go to CIMA, since Kit talked about how SEMA can help. But it's good to understand a basic financial statement and how to prepare a basic financial statement. Today, it's not difficult to find that information on the internet. When you guys understand what revenue is, revenue minus cost gives you profit. The faster you get to profitability, you build a valuable company, right? So you should be able to put together a projection, right? Your investors are going to ask for a 12-month or an 18-month projection. If you're raising money, they'll ask, build the projections for how long you will be using that money, right? Because at the very initial stage, when you don't have revenue, you will only have expenses, right? So that expenses is covered by your investors' money. But investors also would like to know, when will you actually turn profitable, so that you don't need any more investor money. You can just reinvest whatever the company's generating as profits, right? So you would want to know how to prepare financial projections. If you don't know how to prepare financial projections, you should talk to someone who understands how to do this. In Sri Lanka, you have a ton of people who have accounting qualifications, and I'm sure they'll be able to help you out, right? The other thing is, you should be able to defend the numbers that you give to your investors. Don't put bogus numbers you can't meet. And then what happens is, once you give that number, your investors keep that, and then they'll come back to you on a monthly basis and compare the numbers that you have projected versus the actual numbers. So let's keep moving. The other element of talking to venture capitalists is, they'll ask, when they're all happy, okay, they say, okay, you're building a great product, you're solving a big problem, the market's large, we like where you're going to spend the money, we think in the next 12 to 18 months you're going to be profitable. Okay, now we're keen to put the money, right? We're going to give you a $500,000 check. Okay, this is where you will start talking about valuation, right? I mean, they'll want to know, how much of your company are you willing to give the investor, right? Because you will be giving equity, right? There are two types of capital that you can raise. You have equity capital and debt capital, right? You guys know what debt capital is. I mean, you go to a bank, you get a bank loan, that's debt capital, right? You go raise money using bonds, that's debt capital, right? You do commercial paper, that's debt capital, right? Equity is, it comes where debt capital comes with an interest component where you have to pay annual payments, and the only value is, the interest. The only income that debt funders get is the interest income. But on equity, they have all the residual income after paying everything. Whatever that's left over goes to all the equity investors, right? So your VCs usually take equity stake in your company, right? So early stage, if the risk is too high, they may ask 30, 35, 40%, because they want to, because they know that future rounds, you'd have to raise more money, you'd have to do a down round, etc., so that they'll get diluted. So which means they don't want to get significantly diluted in future rounds, right? But as you build your company, your valuation keeps improving, right? Then you lose less. That means when you keep raising more money at high valuation, like I said, you dilute significantly less, right? So they basically, will value your company based on a revenue multiple, or they'll, if you're profitable, you'll be valued at an EBITDA multiple, on a profit basis, or they'll look at a comparable company, right? If you're building an ed tech company, and if you say, I'm going to value my company at 2 times revenue, or let's say you're going to value your company 10 times revenue, but most of the ed tech companies are being valued at 5 times revenue. Nobody's going to give you 10 times the projected revenue that you're talking about, right? So you have to also understand what's going on in the region, right? Something that's similar to Sri Lanka. I mean, obviously you can't compare a company in India to Sri Lanka because, we are 2 different sizes, right? India is a massive market. Their valuations are much bigger, right? So edtech companies in India may go for 15 times revenue, but in Sri Lanka, it probably would go for like 3 to 4 times revenue, right? So you got to have that understanding because it's important, because otherwise you may end up giving too much of your company, right? That's the only downside there. So which as a founder, you don't want to, right? I mean, you want to, what happens in valuation negotiation is both sides want more for them, right? Your investor wants more, you as a founder, you also don't want to give more, too much. But good investors usually don't take a lot because they know that building early stage companies, the startup founders should have enough equity so that they get diluted in future rounds. And, at some point when they exit, they have enough of equity that they can cash out pretty well. Because at the end of the day, the founders are the ones who are building the company, right? Not the investors. The last piece that I want to talk is, your exit, because every investor would, before they put the money, they also think about how do they actually take the money out of the company, and it happens through an exit, right? And there are 3 ways an investor gets their money out. One is an IPO, right? Where your company is spectacularly successful, you're doing billions of revenue, you're profitable, you go listed on the public market, right? And then it's publicly listed. You go listed in the Colombo Stock Exchange, and then your investors can actually sell their equity to the public, right? Otherwise, you can do a trade sale. What is called a trade sale is basically you can sell it to an interested company, right? Like, for example, I said Google buys a lot of these new technology. They go buy all these young startups that are building really interesting technology, because building that inside Google may not necessarily happen, because as a startup, you're focusing on one thing, right? So they are better off actually going in and paying $15 million or $20 million and just buying a company that's building that technology. So that's a trade sale. Investors do get cashed out on a trade sale, but they're probably not as big as IPOs, right? Then the last way investors get money is they don't get their money back. If the company folds, which means if the company shuts down, because you can't find product market fit, you can't find revenue, or if you can't raise follow-on funding, for multiple reasons, if the company fails, then your investors don't get their money back, right? So that is the good thing about raising venture capital, because you don't have to pay it back if your company doesn't succeed, right? It's hard. It's mighty hard, because last year we saw close to about 400 startups, and we invested in only about 6 or 7, right? So our investment rate is like very low, because we we dig a lot. We try to understand whether this is the company that we really want to back, right? But whatever said and done, there are lots of VCs, right? So you should pitch. If you have a good idea, you should reach out to a VC and you should definitely go out there and pitch. I think that's all I have. I mean, I'm just going to open it up for questions. I mean, if you guys have any questions, you can put it on the chat box and I'll answer. Maybe I have like 5 minutes, 5-10 minutes. I can answer some questions.
Mr. Kishan, before we move on to the Q&A session, I would like to give a shout out to our bronze sponsor, SEMA Sri Lanka, IT Solutions partner, MyShabox, and our advisory partner, PwC.
Our story is one of reimagining. Reimagining who you can be, what you can achieve, and how SEMA can support you. Founded in the UK in 1919 with the belief that an accountant's impact goes beyond the balance sheet, SEMA joined forces with the AICPA in the US to form the Association of National Certified Professional Accountants. Today, we serve members and students in 179 countries and territories. Contact SEMA Sri Lanka.
Meet Nadisha and Nipani. They make upcycle products and want to share this passion. So they started a business and took it online using Shopbox. Shopbox is an online commerce solution which allows anyone to easily and affordably sell online. It provides all the tools needed to set up and run your own website. Have your online store set up in minutes by entering your store details and uploading your product. Taking the hassle out of setting up and maintaining an online store, Shopbox helps you work on the more important things, like growing your business. Make your business successful. Shopbox.
If you want to ask them yourselves, we will unmute you and give you the chance to ask your questions. Also, if anyone is watching from the Facebook live stream, you may leave any questions you have in the chat and they will be directed to us. Thank you. Mr. Kishan, we have one question. Hasita has asked whether maximum equity should equity.
So basically, it depends. How you negotiate. It all depends on your negotiation skill, right? I mean, I have seen companies, founders usually give like 5% to anywhere between 30-40%, right? I mean, it depends on the stage of the company. If you are at a very early stage, like I said, investors may ask for a much larger equity, like 30% or 40%. But you also have to be cognizant when investors ask for large equity. That's also a problem, right? I mean, because no good investor is going to try and take a lot from you. because ultimately, it demotivates the founding team, right? So there's no right answer or right or wrong answer. I mean, it depends. But what we say is, look, if you're trying to raise money and if this is the stumbling block, and if don't get too hung up on it, right? I mean, if you have to give 15% or 20% or whatever, that's fine. The extra 5% is not going to really do much. If you can raise the money, that's much better, because you can continue building your company, right? So yeah, I mean, I've seen anywhere between 5 and 35-40%. I definitely don't suggest giving a majority, right? I don't think investors should have a majority stake in early stage companies. Someone's asking if I'm going to share the slides. I mean, I won't be able to share the slides because it's proprietary to the company. But if you have any questions, I'll put up my, I'll give my email address on the chat, and you can send me specific questions, and I'm happy to help you. Sorry, I put it privately. Let me put it to all. I hope you guys got it. Any other?
Yeah. So what sort of powers does the investor have? Let's say I get an investor by giving 15% equity. What are my obligations to him?
Yeah, so basically your investor will say, look, you have to give me monthly financials, right? So that's one thing you have to give him. They may ask for a board seat, right? If your investor is well connected, you should bring them in, right, into your board, because they can advise you on strategy. They can help you find good team members because they are well connected in the network, and they'll know other startups, startups that are doing well, not doing well. They'll know people who are really good, talented people who where they can help you, bring them into your company. So they'll ask for board seat, and they will ask for financials. They'll ask a lot of other stuff, like, you can't, before you recruit any very, very senior people, you have to get approval, because they don't want you to go recruit someone that may not fit with the company. So as an early stage investor, they not only bring cash, but they also bring in a lot of wealth of knowledge and the network, right? So you should take use of that.
Okay, thank you.
I think you can use your mic, and if you have a question, you can ask. You don't have to type it out.
Also, so let's say I get an investor by giving him 15% equity. On what grounds can he pull out, as in exchange his equity for funds again? Can he do that?
Like, you mean give the equity back and you will give the cash back?
Yeah, as in he wants the cash, and in return for the equity he has.
Yeah, so look, if the investor thinks the company is going to do well, he's not going to give that equity back, right? I mean, he'll want to keep it so that, if he puts 100, and if he thinks you can build a company to 1,000, he'll want to keep and make that 1,000, right?
Yeah.
He won't give it back to you. But if the company is not doing really well, yeah, he would definitely want you to buy back. But at that point, you may not have the money to buy back the company, right? So it depends, right? I mean, I've been in situations where the company was doing okay, not extremely well or not bad. The founder said, look, I'll put my personal money and buy you out. So we said, if we get about 2x or 3x, we're happy to sell it. So yeah, I mean, at that point it becomes a negotiation.
So how do we decide the share price of a share?
Well, I mean, there's lots of ways, but at early stage, if you're giving 30% for a company, I mean, if you're giving 30% of your company for, let's say, 500,000 is what you're trying to raise, right? Now that will give you there's something called the pre-money and the post-money valuation. I don't know how many of you have heard that. Probably it's a venture capital term. So basically, your pre-money, your post-money. Let's say you're giving 30% equity, and you're raising 500,000, right?
Okay.
So when you take 500,000 and divide by 30%, you get your valuation of the company, right, which is $1.6 million. right? Your post money is 1.6 million. Your pre-money is 1.6 minus 500, which is 1.1 million is your pre-money valuation, right? That's sort of the crudest way to do it, but that's how it happens in early stage. Because look, it's very hard to tell, right? I mean, we don't know whether this company will succeed or not. So looking at financials and projections and all of that really doesn't make a lot of sense, because and to come for a valuation, because you don't have a history, right? I mean, if it's a mature company, yes, you have a lot of history, so you can use financials. But if you're a new company, I mean, there's no history, right? So it's very hard to use financials and come up with a projection. So I wouldn't really use what these finance guys use, right? They use these discounted cash flow and all of that. I mean, those don't work at early stage venture investing.
Okay.
I think there's another question from Anjula Pereira. What should I look for in an investor? Well, basically, you should make sure the investor is nice. I mean, definitely they're not only giving you cash, but someone who you can work with, and also someone who can add a lot of value to your business, like in the form of strategy, like I said, someone who can connect you with potential customers, someone who can connect you with potential senior employees, so things like that, right? I mean, if you're building a company that is where the investor had invested and have exited, then they'll be able to help you significantly on a lot of the issues that industry faces, right? So they'll be able to add a lot of value in that sense. So yeah, you should interview if you think the investor is ready to put money, you should also find out about the investor, right? You should do your due diligence as well.
Excuse me, I had a small question. So you mentioned with regards to business valuation, and that basically that certain equity would be given on based on that certain valuation. So normally, what kind of the typical mistakes that you see when the people value that carry out this certain business evaluations of their own company when they're offering for investors to invest in their company? How do you ensure that you don't overvalue or essentially undervalue?
No, so look, that's a very hard question, right? I mean, like I said, early stage valuation is very difficult, because let's say if you have revenue, then it becomes a little easier. But if you don't have any revenue, how do you value this company, right? You basically look at so what we do is there's something called the convertible note, where when we can't agree on a valuation, we'll say, okay, we'll put you the money, we'll give you the money, but we'll do it on a conversion where in 12 months, if you do what you're saying, it'll convert at your valuation, which is most likely a higher valuation, right? But if you don't do what you have said, and you don't hit your milestones, then it'll convert at the valuation that we think the business is going to be worth, which is usually set at the beginning, right? So then, basically the founders can work hard to make sure that they hit the milestones so they get their valuation. But sometimes, you can't, right? I mean, the market's not ready. You can't build your product on time. You can't find your team. So when you can't hit those milestones, the investor actually gets his valuation, his or her valuation. So it's difficult. I think it's usually a negotiation at very early stage. But you should go with, if you're very early, you should go to give maybe, I don't know, about 10, 15, 20%. And you also should think, okay, how many more rounds of funding will I need, right? Because if you need more and more money in future rounds, you will get significantly diluted, right?
Right. And also somewhat of a different question, but so as an alternative to giving out equity, that I believe, I'm not too sure whether it happens too much in Sri Lankan context, that an investor would rather than requesting for a certain equity portion, that they would rather give it out as a sort of a long-term loan-ish, or any other sort of...
Yeah, usually investors don't give loans because it depends, right? I mean, if you're talking to a venture capitalist, they usually don't give loans because their fund is not set up to give loans, right? I mean, VCs are, they are there to make money as well, because they have their own investors where they have to return their money back. So they usually don't invest in debt securities.
Oh, so it's only simply just equities they invest in?
Yeah. But at later stage, you should be able to raise debt capital, right? It should be much easier. I mean, I have a company where I invested, 4 years ago, where we raised, capital through equity. But today that company, can go out to any bank and raise money because they have grown quite a bit, and they've shown that they're capable of building a company. They have traction well. I mean, when I invested, they were making like 15 million, 20 million a year. Today they're doing like 600, 700 million rupees a year. So obviously they've gone quite far, right? So using that, we can go and raise money, debt capital. Yeah.
Right. So, but yeah, just one last question. So in general, essentially, like if there's a choice between to like.
Sorry, I couldn't hear your question.
Approach investors to actually give out equity of your company, to actually like try to build your, try to obtain a loan in order to finance it, you would go for. Hello.
I missed part of your question.
Sorry. Very sorry. So essentially, so in the situation, like for a startup company, among the alternative to one, either to approach an investor whereby they had give up part of the equity in order to raise funds, and on the other end, if they could just raise those same funds using sort of long-term loans and debt financing for a startup, which ideally, like what kind of things would you consider? Like,
look. At the end of the day, it doesn't matter, right? Money is money, right? It doesn't matter how it comes. If you can't raise through debt, then you go to venture or equity. If you can't raise through equity, and if you're getting it out of debt, then why not, right? I mean, it doesn't matter. I mean, at the end of the day, you got to find a way to raise the money if you need it. But like I said at the beginning, the best form of capital is capital from your customers, right? If you can build a product and, sell the product to your customers where they are willing to pay for it, that's the best way to raise money. That's the low cost funding. That's actually a zero cost funding, right?
Thank you. Yeah.
Anyway, I think I'll take one more question. I think there's someone on the chat. Would a proper business plan play a major role in convincing an investor? Yes, I mean, definitely yes. You need to start. That's the beginning. I mean, having a good business plan, well thought out business plan is important. You should also understand the industry and the competitors when you talk about your business plan. So like the elements that I spoke about, like, your problem, your solution, your market sizing, and, your financial projections and all of that stuff, it's important because, and your team. So having a good business plan is important, but don't write like pages and pages of business plans, right? I mean, no investor has time to read all of that. Like if I may quickly show you a business plan that's something that will benefit. Hang on a sec, guys. Can you guys see my screen? Right, this is a company that we looked at some time ago. So basically, this is an Indian company. So here, basically, they say, what's their traction? Where are they in their business right now? What's the big problem they're solving? I mean, if you really look at it, it's a lot of pictures, large fonts. They don't write a lot. What's the solution, right? What are the benefits of the product? How big is the market, right? Then, what's the team, right? This is the team, basically, and who are their investors, advisors, and then some endorsements from customers, right? So essentially, this is not a lot of work. I mean, you should be able to tell a story, right? That's the most important thing. It's all about telling a story at early stage, because you don't have anything else to show, right? You can't take them to your company because you don't have a company. You can't, if you haven't built a product, then you can't show the product, right? I hope the session was useful. I hope, I answered most of your questions. But if you have any other questions, send me an email and I'll be happy to respond. Over to you, Santi.
And that brings us to the end of the fourth workshop of Jumpstart. I would like to thank Mr. Kishan Nadarajah for joining with us today and for sharing your time and knowledge with us. I'm sure everyone who joined today learned a lot of valuable things. Thank you so much once again.
Thank you. I'm very happy and glad that I got to spend an hour and a half with all you guys. Happy to help. I mean, go out there and build something that's going to be exciting.
Thank
Great.
you, Mr.
Thank you. Bye.
Thank you, Mr. Kishan. Bye.
Okay.
Good night.